This week, the Federal Reserve has raised interest rates for the first time since 2018. This was in line with market expectations, and we are seeing stocks rally in response. Ted Oakley is the founder of Oxbow Advisors, and he joins us today to talk about what he plans to do in response to this. And he says that the stock markets have not capitulated yet, but it could be only a matter of time. Ted, welcome back.
Thank you, David.
Lots to go over today. Let's start with the Fed. So I'm just going to read parts of the statement that came out from the FOMC earlier this week. Federal Reserve Jerome Powell has stated that the economy is ready to handle more interest rate hikes. He said the FOMC acutely feels the need to restore price stability. And he predicts that we could potentially see the Fed funds rate rise to 1.9% by the end of 2022 and climb to 2.8% by the end of 2023. So that implies several interest rate hikes, not just 2 or 3, but potentially a lot more. Do you agree with Fed Chair Powell's assessment that the economy is ready to handle several interest rate hikes by the end of 2022 and beyond?
Well, I would say no, David. I mean, I think we're already rolling over. The economy is already weakening to a degree. And it's interesting because we've done some work on this in the past, but if you look at the last 15 or 20 years about Fed looks into the future and what they look at GDP and inflation and et cetera, they're only about a 25% rate. Their batting rate's not very high. So I wouldn't necessarily use that, but I would say this. I mean, if you start to look at things like, I'll give you one example this week. Empire State came out, at the first time really since 20, they're down 11%. The hours work's down, wages down, manufacturing down. And I think you're going to see that more and more as we get into 22. And I think they will eventually realize that they are raising, which is par for the course, actually. They're raising into a slowing economy. And I think that's why they never get to one of those big numbers.
Okay. The FOMC's projection for 2023's GDP growth is at 2.2%. Now, if they're projecting interest rates to rise by 2.8% by the end of 2023, that implies interest rates higher than the GDP growth. Is that at all a concern for you, or are the two variables completely unrelated?
Oh, that's a big concern, because what happens is when you look at it, if you're not growing your economy, if you're growing your economy less than what you're having to pay for money, then you're going backwards. We're already going backwards if you look at inflation relative to the whole thing, but you're really going backwards at that point. And if you look at the Atlanta Fed, I think the first quarter now they're down to either 0 or 0.1. They've been pretty good on the GDP.
Yeah.
So again, people have to realize, David, that the Fed is looking backwards. The information they have in hand that they act on are things that have already been announced. They're not things that are going to happen in April, May, June, July. And so that's how they operate. And they have, a lot of PhDs, a lot of academics, and that's how they look at hard facts that are already there. All right. Unfortunately for them, and for everybody else, the market discounts this next 10 to 12 months. So it could be totally different than what they think it's going to be.
Okay. I'm just going to make another reference to Powell's statements here. He said that he does not see the risk of recession rising anytime soon. I'm paraphrasing here, but that's basically what he said. Do you agree with that statement?
I don't. I would be, in Oxbow too, we would be surprised if we get through 22 or early 23 without at least one down quarter. I think you would have at least one. And maybe people look at that and think that we're overly negative. But if you just look at where we came from in 21 and then what's happening in 22 with everything, it's pretty easy to get to that. But it could be more than that. I mean, if they just keep on trying to raise and are hard-headed about it, they could push you into a 2-quarter recession or more, if it could.
A 2-quarter recession, Ted. What's going to trigger that? Do we even need a trigger?
If they did, I'm just saying, David, let's just say they did raise 6 or 7 times this year. I think that alone is going to put you at 1-quarter recession and maybe higher.
It sounds like they might. I mean, if the Federal Reserve Chair is saying that the economy is ready to handle it, I don't see why they wouldn't.
Well, the reason they wouldn't is this, and they can turn on a dime, and I suspect they would. I don't think you're low enough. You know, they place everything, everything is on the stock market. I mean, you just look back at their history the last 12 years. It's all on the stock market. Now, their idea is that, well, we can live with 15% or 18% on the stock market down, but you get down 35 or 40% after they keep on raising these things, and you're going to find out what they're really made out of it. My guess is that they won't have the ability to hang in there because they never have had in the past. So maybe they change, but we'll have to see.
All right, we're gonna keep the audience hanging for just a bit, and we'll talk about your stock market projections towards the latter part of the interview. I want to talk about the yield curve. It's an indicator that economists use to gauge whether or not a recession is happening. Usually, when the yield curve steepens, it means that we're in an economic rebound or period of economic growth. The opposite happens when we have a flattening of the yield curve, which is what we've been seeing since the better half of last year. Since basically 2021, May in 2021, the yield curve peaked and it's been flattening, and it's continued to flatten. Now, is this something that concerns you as an investor? Are you using this indicator to gauge whether or not a recession, first and foremost, is happening, and number two, whether or not to rebalance your assets?
Well, what we use it for, if you look at the 2 to 10-year Treasury spread right now, David, it's about 21 or 22 basis points. It's almost zero, okay? And so what we look for and what we think will happen is they will keep that will keep shifting till all of a sudden, you know, the 2s are higher than the 10s and 2s higher than the 15s. Then all of a sudden you're in a position, then we probably are. I mean, if history is any guide, you really are going to go into recession at that point in time. And so I think that's what you have to watch here for. And the way you want to look, if you're a fixed income investor, what you want to do with that is remember, you can keep a lot of things really short within 1 year, 18 months, but you probably should have some, and I'm saying 10, 15% really long, okay? Because those will come down as the short goes up if you're going to flatten the curve. Sounds sort of contra, but that's the way the yield curve works.
All right. So given that assessment, I want to talk about what you think is going to happen to interest rates this year. Given your macroeconomic outlook and given the Fed's position, how many rate hikes do you think can realistically happen by the end of 2023?
Well, 23, I can't. It'd be hard for me to say what would happen in 23, but I think.
All right, let's start with 2022.
Dead ahead, I think in 22. It's hard for us to see them getting past one more. And I would say this is the reason why. If you look right now, for example, I'll just take one thing, okay? Take the 30-year mortgage at about a 418, 420. If you look at that, that's a lot higher than it was 18 months ago at a 280. All of a sudden that payment really changes. And see, all of a sudden it creeps into day-to-day things. And I think that's what they're going to find, that all of a sudden you're pushing that into day-to-day situations. But we would be surprised at more than, actually, it wouldn't surprise us just to have one, but it would certainly surprise us to have more than two. And that's because we don't think the economy can stand it.
Well, what is one interest rate hike going to accomplish, Ted? If you take a look at the Fed's mandate of controlling inflation and maximizing employment, what is a 25 basis point hike going to change, if anything?
Yeah, it changes. All it changes is sentiment, really, and maybe outlook for people. But the main thing they have to keep in mind, David, is if you look at inflation in the second and third quarter, 21, okay, they were like 5.5, 5.75, and then the fourth quarter was like 7.5. See, so the time when you get in comparison mode this year, okay, just from base effects alone, okay, your inflation rate's going to go down. And when it does, and you look down, look at soft commodities, you're starting to see some of the foods rolling over. All of a sudden, you look at the ports, they're probably down 80% from the time it takes to get those things out of the ports. Now, there's a lot of things happening that probably changes that. But what happens is it's not so much the one and done thing. It's just that they're looking backwards. And so as you get more information over the next 3 to 6 months, then they've got to deal with that. And our idea is that information will be slower. And when it comes about, it makes them take pause. I think we'll see. Maybe they're hard-headed about it, but it'd be the first time.
You mentioned to me offline that we are in a classic bear market. Well, okay, explain what that means, because just in the last couple of days, since the Fed announced a 25 basis point rate hike on Wednesday and on Thursday, we're seeing markets rally. By markets, I mean the stocks in particular. So clearly, someone feels bullish. I'm not saying that's necessarily you, but somebody out there feels bullish.
Oh, you're exactly right, Dave. In fact, last week, had one of the biggest weeks they have had coming into equities last week, and the biggest weeks selling bonds. What happens in a classic bear market is this: you go down 5% and you rally 2, you go down 8, you rally 2 or 3, you go down 10. It's one of those stair steps down, and everybody along the way tries to pick the bottom. And that's why you see this money rush in. We've had 2 big days, basically on Tuesday and Wednesday. The reason for that is because they think, hey, I've got the bottom now. This thing's over. We're good to go. Okay. In a classic bear market where we are right now, it takes them out again. And that's what's happened since January 1. Every time they thought they had it licked, it came along and took you to a lower low. So then they had to turn around and turn some things and sell them. But we really haven't had the fear or capitulation that we see in a really serious low. And the other thing is, we put together some graphs like this, but if you look last year in 21, and you've seen this before, but out of Bloomberg will tell you that more money came into equities in 21 than all of the other 19 years prior combined. So you had this huge amount of money that came in. So we drew a line backwards from where we are at the markets today, NASDAQ, Dow, S&P, into 21. And that line intersects at about February or March of 21, meaning that almost everybody that bought last year and all that money is underwater. And if you're underwater, you keep thinking it's going to come back till you finally capitulate and say, hey, I'm done. And we haven't gotten to that point. So the prices are too high, really. The multiples are too high for us.
Okay, we haven't gotten to the point of capitulation. Well, I agree. I think markets are still rather elevated compared to where prices were a year ago, let's say. So what's going to get us to that point of capitulation?
Oh, I think you have to go, if you look, I think you would have to get the markets in a 30%, probably 15 points more down from where they are now, 30% or lower, for people to really wake up. Think about it like this: if you've been in an index fund since and then the last 5 years, you're probably, obviously, let's just say since March of 20, you're up 90% or so, from that low in 20. And so, you lose 15% in here, and you're like, it's okay. I still made a lot of money in that period of time. However, when you get up to 30, 40% or more, then all of a sudden you're like, well, wait a minute, I'm going the other way. So I think that's still ahead. We'll see if it is, but that's what we're thinking. The second quarter and probably part of the third will be weaker than the first.
Okay. Ted, let's talk about the interest rates in relation to the stock market. So it seems to me like we've got a bit of a chicken and an egg problem here. If I may make that comparison, you said earlier that the Fed is going to stop raising interest rates if the market's correct by 20, 30%. Now, what if the markets don't correct by, let's say, 2 or 3 rate hikes anymore? Are they going to keep going, or are they going to say, wait a minute, if I keep going, the markets might correct? So what needs to come first, rate hikes or market correction?
Well, it will all have to do with how much information came into them in the months in the future. Let's say, for example, they have February information, so that's what they're working from. Then you'll have to look at March. And March, probably because of the first 10, 12 days, which things were still high then, it probably will come in, reasonably strong with the numbers. Now, April, I think a different story. I think by the time you hit April, May, June, those numbers are not going to be as strong on the up. I'm talking about inflation wise. I think that's what you key off of. And if we're wrong, it will show up for us when the April and May numbers come out. The March, it's sort of borderline, but April, May should be much weaker on the inflation side. And if it is, I think that will make them really at least stop and think.
You mentioned also to me offline that certain sectors are overvalued. Which sectors are the most overvalued right now, and by how much?
Well, I think the stock market in general is overvalued. If you look at where we would like, if we look, we'll just take multiples of the general market S&P. We think it'd have to be about 15% lower in the really great growth stocks for us to get an interest, to have more interest. Now, we own a lot of them already, don't get me wrong, but we've got a lot of cash. To add to those names, which is basically what we would do, we would have to get more than what we have to try to get it back in line to something that's a little better buy than what it is here.
Okay. All right, I want to comment on Ukraine real quick in relation to the markets. People are saying that geopolitical tensions eventually will lead to a market correction. Well, first of all, the markets have already begun correcting even before Russia invaded Ukraine. And if I look at the past bear markets since the 80s, we've had 1987, 2000, 2008, 2020. So 4 bear markets or market crashes, if you want to call them that. None of these were precipitated by a war. So if I may make the statement that wars don't cause bear markets, would you agree or disagree with that?
I think that's true. I think for people to be investing based on the Ukraine situation is not a good format. I mean, I'm not saying it would or wouldn't do something, but I would not use that as my benchmark for what I wanted to do in the marketplace. Because you're correct in saying that most of the bear markets they didn't come off of a war.
Okay. So given everything we've discussed, how are you positioned right now? You've got a few strategies. So tell us about your strategies and what you've done differently since last we spoke.
Well, we have 3 strategies. We have a conservative income strategy that's really, really conservative. It is very, very safe. And we have a more aggressive income strategy, and that's where we own commodities and inflation hedges and all that sort of thing, but they're all cash flow type things. And then we have a growth strategy that's nothing but growth stocks. We're not trying to match up the S&P 500. We want companies that can grow at 15% a year. But in the conservative income strategy, and I don't think people realize this today, but you can start to really, even if you're just holding liquidity, okay, you can get 77, 78 basis points on a 6-month treasury, fully guaranteed. You can get 1.25 on a 1-year treasury. It's been a long time since you could get that type of yield for taking very little duration risk. And so what we've done in that portfolio is we've picked up a lot more short paper. However, we've added about 10% to the long end treasury, the 25 or 30, because what we think will happen when you flatten the curve, those long rates will go down, the short rates will go up. So we don't want to be much past 6 months or a year. If they do go up, we'll kick out into 3 and 4 and 5 year paper, to try to lock in some really good yields. And that's how we structure a really conservative portfolio. On the high income side, what we've done is we've taken a little bit of we had a lot of energy and had it for a long time. So we've taken a lot of the energy, not names that just ran up, 100, 200%. We've taken some of those off. We didn't completely get out of it, but we basically sold those positions down some. I mean, we took they got too expensive. We still own most of them. The only thing we're completely out of is Valero, but not because we don't like the company, because it got to a point where we wanted to move it. And we've done that on a few other things, a few of the inflation hedges, but by and large, that portfolio also has taken a position in the 20 to 30 year treasury, not quite as much as the fixed income, but there it goes. The fixed income and the high income strategies both have around 37, 38% liquid. We think we'll have a great opportunity somewhere this year to really use a lot of that money. And then on the growth side, any portfolio manager tells you they have an easy time this year is probably not managing a lot of money, because it's a tough year to trade. And for us in the equity side, for example, we have about, like I say, 31, 32% liquid. We use that as an opportunity, because if we get what we expect we would get, we will really pick up some great buys, which could be, you could go from down 30 to down 5 and really have a pretty good year if you have a lot of liquidity. And so that's the way we look at that.
Final question for you, Ted. You mentioned that we are in a classic bear market. Is there anything that the Fed can do to prevent this bear market from being exacerbated by any external macro forces?
Well, I don't think at this point, because they're late in the game. And since they are late, they're fighting last year's war, so to speak. I'm talking about inflation. And now you're going to go into a situation where obviously, through last Friday, the NASDAQ was down 20 and then Russell was down 21. And you hadn't heard much about that from them. So I think it's not bothering them too much. However, that's what I'm saying, you get down 30, 35, 40, everybody's 401ks are down, their personal accounts are down. See, people feel the last 2 or 3 years, they really feel wealthy because their stocks, their 401ks, their homes, their real estate, all sky high. And it's like, man, this is great. Well, if all of a sudden that changes, because when I don't think people realize, when you get down 40%, 35%, you've got to make a lot of money to get back even. And I think that would change them, but I don't know. I think that would change them, though.
Okay. Ted, I'm not going to ask you about Dogecoin and Shiba Inu. Maybe that's the way to get back to a full portfolio value after you're down 40%. I jest, but anyway, thank you for your comments. I appreciate your insights. We'll speak next time.
Okay, David. Thank you.